Something quietly broke over the recent period, and most people missed it because they were watching screens instead of reality. There was no emergency headline, no press conference, no market alert. The shift did not begin in financial markets. It began in the physical world, where ships cannot move faster because sentiment improves, where mines cannot double output because prices flash green, and where governments are slowly reminded that resources are not ideas. They are real, finite, and unevenly distributed. While paper markets debated narratives during thin sessions, the scramble for physical silver and critical resources moved from background tension to center stage. Once that shift happens, it does not reverse quietly. This is the uncomfortable truth. The world many people keep predicting has already arrived, but it arrived without ceremony and without warning. A multipolar world is no longer theoretical. It is the environment markets are now operating within. When power fragments, the focus stops being about interest rates, valuation models, or earnings projections. The struggle shifts toward control of energy, minerals, and materials that keep modern systems functioning. Oil, gas, rare earths, industrial metals, and silver are no longer passive inputs. They are leverage. This is why events that appear political on the surface are almost always resource-driven underneath. Volatility is mistaken for speculation. Price declines are misread as weakness. But what is actually unfolding is a collision between two systems. One system trades claims, leverage, and promises. The other system moves metal, energy, and physical supply. Right now, those systems are no longer aligned. That misalignment explains a pattern many fail to understand. Paper pressure appears during thin hours while physical demand responds when real buyers step in. This is not coincidence, it is structure. To grasp what comes next, you have to stop thinking in isolated events. This is not a single spark. It is a chain reaction already in motion. If this perspective makes sense to you, press 1 in the comments and subscribe to the channel. To understand why this chain reaction is accelerating, you have to look beyond markets and into incentives. Systems behave according to what they reward. For decades, the global system rewarded leverage, financial engineering, and paper claims. As long as credit was cheap and trust was assumed, efficiency mattered more than resilience. Supply chains stretched across continents because cost mattered more than control. That logic worked until it did not. When pressure suddenly appears around an energy-rich region, it is rarely about stability alone. It is about barrels, pipelines, shipping lanes, and who settles trade in which currency. When frozen territories or maritime choke points become strategic priorities, it is not symbolism. It is minerals under the surface and control above it. Ideology may dominate headlines, but resources determine outcomes. This is where confusion sets in. Many people see volatility and assume chaos. In reality, what they are watching is adaptation. When access is threatened, alternatives are built. New trade routes form, settlement methods diversify. Infrastructure follows incentives, not speeches. Every time this happens, the financial plumbing beneath the surface changes slightly. Not dramatically, not overnight, but persistently. Two battles are now unfolding at the same time. One is physical. It revolves around energy, metals, and materials that keep economies functioning. The other is financial. It revolves around the unit of account used to price and settle that trade. These battles are connected, but they do not move at the same speed. Financial markets react instantly. Physical systems move slower, but they carry weight. This mismatch creates stress. Paper markets can manufacture abundance through contracts and leverage. Physical markets cannot. Metal either exists or it does not. Energy either flows or it does not. When these realities diverge, signals become distorted. Prices swing. Narratives conflict. Confidence erodes unevenly. This is why the phrase matters. You cannot sanction geology. If the material exists and demand persists, trade will find a path. Each path built outside legacy systems reduces reliance on them. That erosion is subtle but cumulative. It does not announce itself. It reveals itself later through volatility, trust decay, and pressure where systems are weakest. This is the foundation beneath current market behavior, not speculation, not emotion, structure. Place the United States inside this framework, and the dynamics become clearer. For decades, global reach was sustained by a system built on credit. As long as dollars flowed outward and recycled back into domestic assets, borrowing costs stayed manageable and constraints felt distant. The bill existed, but urgency did not. That gap is closing. When balance sheets stretch and interest costs rise, resource access becomes critical. Interruptions are no longer tolerable. Policy shifts follow pressure, not preference. Alliances are tested, guarantees are extended, pressure is applied. Not because leadership suddenly becomes reckless, but because the alternative is slow erosion of industrial capacity, military readiness, and economic stability. This is where multipolar reality rewrites strategy. In a unipolar system, refusal carried consequences most could not survive. In a multipolar system, refusal becomes survivable. That single change alters leverage, options expand, dependencies surface, assumptions weaken. Now connect this directly to silver. Silver does not need to disappear to disrupt systems. It only needs to tighten. When delivery times stretch and premiums rise, industries begin competing with investors and savers. Because silver remains accessible compared to gold, it is easier for individuals to accumulate. That combination matters. Accessibility paired with uncertainty creates demand waves that stress an already constrained market. Silver sits at an uneasy intersection. It is both an industrial necessity and a monetary metal. Industrial demand grows through electronics energy systems, medical uses, and advanced manufacturing. Monetary demand rises when trust weakens. Add geopolitical pressure and volatility becomes unavoidable. That volatility is not random. It is pressure-seeking expression. As power decentralizes competition, shifts away from financial engineering and toward resource control, critical minerals and industrial metals are prerequisites for resilience and security. Yet much of the refining and processing capacity has existed outside domestic control for years. When that reality becomes unavoidable, urgency replaces comfort. Mines take time. Refineries take time. Capacity cannot be rebuilt overnight. In the short term, you do not build your way out. You secure what already exists. That reality defines silver's growing importance in this transition. Once resource access becomes urgent, currency can no longer be separated from strategy. Reserve systems persist through habit incentives and enforcement until they do not. For years, energy producers and large buyers have been quietly reshaping relationships through infrastructure projects, logistics corridors, and long-term supply frameworks. These were not symbolic gestures. They were practical decisions designed to reduce friction and exposure. Trade flows determine currency usage. The dollar-centered system was never sustained by trust alone, it was sustained by settlement. After the final break from gold, energy pricing anchored global demand for dollars. That mechanism worked because it aligned incentives. But incentives evolve. When access to resources becomes less certain, flexibility becomes valuable, reduced exposure becomes rational. This does not mean dominance disappears overnight. Network effects decay slowly. But decay is not the same as stability. When trade increasingly settles outside legacy channels, even incrementally, reliance weakens. What once felt automatic begins to require effort. Supply chain security rises in priority as currency convenience declines. This is where silver re-enters the picture with clarity. Silver is not a distraction from the larger system. It is a stress point within it. The deeper issue is not whether a currency vanishes, but whether it retains purchasing power. Currencies rarely collapse dramatically. They erode quietly. They continue to function while buying less over time. That is why metals matter. Gold and silver carry no counterparty risk. They do not depend on trust in an issuer. They depend on physical existence. In an environment shaped by debt expansion, rising interest burdens, and geopolitical fragmentation, that distinction grows more important. Decades of spending commitments and leverage have left structural pressure. Add corporate debt, household leverage, and layered derivatives, and sensitivity increases. When that pressure meets a multipolar world, disruptions feel larger and reactions intensify. This context explains why volatility is rising beneath the surface. It is not random. It is the system adjusting. And silver sitting between industrial necessity and monetary defense reflects that adjustment more visibly than most assets. Silver's position becomes clearer when you examine supply rather than price. Price can be managed. Supply cannot be negotiated. A critical detail often overlooked is how silver is produced. Most silver is not mined for its own sake. It is a byproduct of other mining operations. That means supply does not respond quickly to higher prices. Even sustained price increases do not guarantee immediate output growth. Production depends on the economics of base metals, not silver demand alone. This creates a structural constraint. When demand rises, supply lags. When inventories tighten, relief does not arrive on schedule. That lag is why tight conditions persist longer than expected. It is also why volatility increases. Markets attempt to price scarcity while operating inside a leveraged structure designed to assume abundance. This tension shows up in behavior. On the paper side, contracts can be created, rolled, and settled without metal changing hands. On the physical side, delivery either occurs or it does not. Inventory either exists or it does not. That difference explains the repeated pattern frustrating many participants. Price weakens during thin sessions, narratives form, stops trigger, then real demand appears and absorbs supply. This is not coincidence, it is a conflict between convenience and constraint. When physical buyers remain active, paper pressure loses psychological force. What once intimidated becomes opportunity. Each purchase removes metal from circulation, tightening the system further. Zooming out removes emotional noise. Longer time frames reveal a market attempting to reprice scarcity under structural pressure. Silver does not move smoothly. It whipsaws tests, conviction, and exhausts attention. That behavior is not a flaw. It is a filter. It transfers exposure from reactive participants to those anchored in structure. This is why silver cannot be understood through charts alone. It must be understood through supply dynamics, industrial dependence, and monetary context. When those forces align, price eventually follows. Timing remains uncertain. Structure does not. To see where this leads, focus on behavior rather than headlines. Demand for silver is not isolated. It comes from industrial users, strategic buyers, and individuals seeking protection from currency erosion. Across multiple regions, accumulation has been steady and deliberate. When participants with long horizons increase exposure to hard assets, they are not speculating. They are managing risk. Silver supply depends on global trade. Refining, processing, and logistics shape availability. In a world where relationships are being renegotiated, that dependence introduces vulnerability. When large buyers consistently increase imports, it signals intent. Silver is being treated less like a trading instrument and more like a strategic material. This tension appears clearly in market structure. Paper markets offer speed and leverage. Physical markets operate under constraint. Delivery either happens or it does not. Inventory either exists or it does not. When these realities diverge, price behavior becomes erratic. Sharp declines coexist with persistent demand. This explains why overnight pressure has lost impact. Repeated attempts to force prices lower are met by real buying. Each cycle removes metal from circulation. Tight conditions persist. The psychological power of paper volatility weakens as patterns repeat. A broader rotation is taking shape. When assets are measured against tangible materials rather than currency units, long-term trends shift. Periods dominated by paper wealth eventually give way to phases favoring real assets. These transitions are slow and uneven. Silver sits near the center of this adjustment. It reflects industrial necessity and public sentiment simultaneously. Volatility is not a warning. It is feedback from a system under strain. As this adjustment continues, the imbalance between paper scale and physical scale becomes clearer. Paper markets can expand without limit. Physical silver cannot. Metal must be mined, refined, transported, and stored. That asymmetry matters. Even small shifts in capital allocation can create outsized pressure in a constrained market. This is why silver does not need broad participation to move. It only requires marginal reallocation. When a fraction of financial capital seeks exposure to physical assets, stress builds quickly. Governments and industries understand this. That is why quiet stockpiling and long-term supply agreements are increasing. Much of the processing capacity for critical materials remains concentrated outside domestic control. This is industrial reality. When refined inputs essential for technology and defense originate elsewhere, leverage exists. Strategy adjusts around that fact. Attempts to redirect supply chains are underway, but they take time. Mines and refineries cannot be built overnight. During this transition, competition for existing supply intensifies. That competition appears in pricing behavior and policy responses. Currency dynamics amplify the effect. Dominance relies on network effects, and network effects weaken unevenly. When trade becomes anchored through infrastructure and long-term agreements, reliance on legacy settlement systems declines. In this environment, silver functions less as speculation and more as insurance. Its volatility reflects adjustment, not disorder. Transitions are rarely smooth. Volatility filters participants, rewarding those anchored in structure rather than emotion. At this stage, the conflict becomes psychological. Structure sets the conditions, but behavior determines outcomes. During transitions, markets are not designed to offer clarity. They are designed to exhaust attention. Rallies create fear of missing out. Pullbacks generate doubt and regret. The cycle repeats until participants detach emotionally or exit entirely. This process is deliberate. It transfers exposure from reactive behavior to patient positioning. Silver intensifies this effect. It moves fast enough to provoke emotion and slow enough to punish impatience. Without a macro anchor, every move feels personal. Each dip feels like failure. Each rally feels temporary. Volatility is misread as danger rather than understood as a mechanism. Anchoring changes perception. When focus shifts from intraday noise to longer structures, from narratives to ratios, from price alone to supply, a clearer picture emerges. Accumulation often occurs beneath disorder. Price swings reflect pressure, not collapse. That distinction changes behavior. Paper pressure targets weak resistance. Thin sessions allow narratives to form quickly. This strategy relies on psychology. It assumes defensive reactions. But when physical demand remains steady, its impact fades. What once intimidated becomes opportunity. Each cycle requires more effort for less effect. Pressure fades through diminishing returns. The physical market does not argue. It either absorbs supply or it does not. Recent behavior suggests absorption continues. Many wait for confirmation before positioning. Confirmation usually arrives after repricing. Awareness matters more than precision. Silver does not reward constant reaction. It rewards alignment with structure. In a period of transition, patience becomes a strategic advantage. As this transition advances, broader patterns become visible. Markets do not move in isolation. Asset classes rotate as confidence shifts. Periods dominated by financial assets eventually give way to phases where tangible assets regain relevance. These shifts unfold gradually and often go unnoticed until they are well underway. Relative measurement reveals this change. When assets are evaluated against real materials rather than currency units, long cycles appear. Purchasing power moves. Emphasis shifts. What once led begins to lag. This is not elimination, it is rebalancing. Silver occupies a distinct position. Gold often reflects central bank behavior. Silver reflects industry and public response. When silver begins to assert itself, it usually signals acceleration, not initiation. That acceleration rarely feels orderly. Volatility increases, narratives multiply, confidence fragments. Models built for stable conditions struggle to explain behavior shaped by constraint. Explanations follow price rather than lead it. Scale mismatch amplifies this effect. Paper markets are vast, physical silver markets are small. Marginal reallocations can create outsized pressure. Universal participation is not required. This is why waiting for consensus carries risk. Consensus forms after repricing. Awareness matters more than validation. Silver behavior is not isolated. It reflects a broader adjustment across resources, currencies, and confidence. The question is no longer whether change is occurring, it is whether participants are prepared to navigate it deliberately rather than reactively. What matters now is not predicting a single outcome, but understanding direction. Systems rarely change in dramatic moments. They adjust through pressure and rebalancing. The environment taking shape is defined by resource competition, rising debt sensitivity, currency strain, and declining tolerance for fragility. These forces persist regardless of short-term market calm. Silver sits at a critical intersection of this adjustment. It is neither purely defensive nor purely speculative. It responds to industrial necessity and monetary stress at the same time. That dual role explains its volatility. It reflects both function and fear. Many wait for certainty before acting. Certainty usually arrives after repricing. By the time consensus agrees, opportunity has shifted. This does not mean acting blindly. It means grounding decisions in structure rather than emotion. Long-term alignment matters more than short-term precision. Another risk is underestimating erosion. Currencies rarely fail loudly, they weaken quietly. Purchasing power declines, flexibility narrows. Assets grounded in physical reality gain relevance not because collapse is imminent, but because resilience becomes valuable. Silver does not promise outcomes. It offers alignment with tangible value in a system shaped increasingly by constraint. Volatility becomes information rather than intimidation when viewed through that lens. The world is reorganizing around resilience and resource security.